If you're looking at dividend stocks, this video could save you from a very common mistake buying purely on yield. A high dividend can look attractive, but if it isn't backed by revenue stability, profitability, and free cash flow, it often doesn't last. So today, I'm breaking down and ranking 8 popular UK dividend stocks. For each one, we'll look at what the company does, how it generates cash, how sustainable the dividend is, and the real risks investors tend to overlook. First up is Aviva, ticker AV. Aviva is one of the UK's largest insurers, operating across life insurance, general insurance, pensions, and long-term savings. It makes money by collecting premiums upfront and investing that money over time. Insurance companies like Aviva can be solid dividend payers as long as claims are controlled and investment returns remain stable. The dividend yield is currently 5.7%. From a cash flow perspective, Aviva generates steady operating cash flow, which is what ultimately funds dividends. The main risks are higher than expected claims, market volatility impacting investment income, and regulatory capital requirements. Competition in UK insurance can also pressure margins. On reported earnings, the payout ratio looks high, but for insurers, cash generation and solvency matter more than a single year's earnings. So, as a dividend stock, I'll score it a 7 out of 10. Next is M&G, a UK-listed asset manager and savings business. It manages money for individuals and institutions, and it earns fees based on the amount of assets it manages, which means revenues rise when markets rise and fall when markets fall. If M&G maintains assets under management and avoids major outflows, it can generate meaningful cash flow to pay a strong dividend. The dividend yield is currently 6.6%. Market sensitivity is the biggest risk. Outflows reduce fee income, and regulatory changes can also affect profitability. On reported earnings, the payout ratio looks extreme due to negative earnings, which highlights that this dividend is more exposed to market conditions than more defensive income stocks. So, I'll score it a 5 out of 10. Legal & General is one of the UK's largest insurers and asset managers, operating across life insurance, pensions, annuities, and investment management. Revenue comes from insurance premiums, asset management fees, and long-term retirement products. This type of business can generate predictable cash flow, which is why it's popular with income investors. L&G has one of the highest yields in the FTSE, currently 8%. The main risks are interest rate changes, low rates hurt profitability on new annuity business. There's also longevity risk. If people live longer than expected, pension payouts increase. On reported earnings, the payout ratio looks extremely high. However, insurance earnings can be volatile, so this may reflect timing issues rather than fundamental problems. Still, it's a red flag worth monitoring closely. So, as a dividend stock, I'll score it a 7 out of 10. Now, let's look at Phoenix Group. Phoenix is the UK's largest life and pensions consolidator. Unlike traditional insurers, it buys closed books of insurance and pension policies and manages them for profit over time. Because Phoenix isn't writing new risky business, this model can generate forecastable long-term cash flows, which is why dividends are central to the investment case. The current dividend yield is 7.3%. The main risk is acquisition quality. If Phoenix overpays for a book of business or misjudges the liabilities, profits suffer. Other risks are interest rate sensitivity and regulatory capital constraints. Operational efficiency is crucial too. These are low-margin businesses, so cost control is everything. Phoenix's reported earnings are currently weak, which makes payout ratios look negative, meaning dividend sustainability depends heavily on cash flow execution going forward. So, I'll score it a 6 out of 10. Now, moving outside financials, British American Tobacco sells tobacco and nicotine products globally. These products generate strong cash flows due to pricing power and brand strength. Even as volumes decline in developed markets, pricing and emerging market exposure have helped sustain cash generation. The dividend yield is currently 5.3%. The biggest risk is regulation. Governments continue to tighten restrictions on tobacco advertising, packaging, and sales. Other risks are litigation, declining smoking rates, and uncertainty around next-generation products. So, BAT can be a powerful income stock, but the trade-off is you're accepting a business with structural and political headwinds. Reported earnings make the payout ratio look high, but BAT's dividend has historically been supported by free cash flow rather than accounting profits. So, I'll score it a 7 out of 10. Next is BP. BP is a global energy company spanning oil and gas production, refining, and energy transition investments. Oil majors like BP can be dividend powerhouses when energy prices are strong, but the business is highly cyclical. The dividend yield currently sits at 5.3%. The main risk is oil price volatility. There's also the energy transition. BP is investing billions in renewables and low-carbon energy, which may generate lower returns than traditional oil and gas. Regulatory risks around carbon emissions are increasing too, and BP has a history of dividend cuts in stress periods. Reported payout ratios look high during weak commodity periods. Oil companies often use cash reserves during downturns to maintain dividends, which is why energy dividends should never be treated as guaranteed. So, as a dividend stock, I'll score it a 6 out of 10. Schroders is a global asset manager serving institutions, pension funds, and wealthy individuals. It earns fee income based on assets under management, which are sensitive to both markets and client outflows. The dividend yield is currently 4.7%. Market sensitivity is the key risk. When markets fall, assets under management shrink and fee income drops. Client outflows are another concern, and competition from low-cost index funds is pressuring fees across the industry too. With a payout ratio of 94.9%, Schroders is paying out nearly all its earnings. It's close to the limit, but still technically sustainable if earnings hold steady. So, as a dividend stock, I'll score it an 8 out of 10. Finally, Admiral Group, ticker ADM. Admiral is a UK car insurance specialist also operating in home insurance. Car insurance can be excellent dividend payers when underwriting discipline is strong, and Admiral has a long track record of profitability and generous dividends. The dividend yield is currently 8.4%. The main risk is claims inflation, and competition in car insurance is fierce, with many players fighting for market share. With a payout ratio around 65%, Admiral has a healthy and sustainable dividend policy. The payout is reasonable and leaves room for both dividends and reinvestment. So, as a dividend stock, I'll score it a 9 out of 10. So, those are the 8 dividend stocks to consider. But remember, dividend investing isn't about the highest yield. It's about cash flow durability, balance sheet strength, and understanding the risks you're accepting. Which of these do you own, and which one should I break down next? Let me know in the comments, and don't forget to tap the like button and subscribe for more investing content and dividend investing strategies. Thanks for watching, and I'll see you in the next one.